Hi, this is Wellington from Wellsway. Today, we will go one step deeper in personal finance. Personal financial management is concerned with how money is to be earned, how money is to be spent, how to save, and how to invest the savings. Easily said than done. Each of the above areas need a lot of theory to be studied. Once we develop the skills needed, we can go on to practice them. The results of such practice will come to you much later, and then you will thank yourself. So, let us embark on a method to help us achieve our aims in personal financial management. This method requires one to build a personal finance scorecard in order to monitor how you have been conducting yourself in the areas of earning, spending, saving, and investing money. Let us see how. Well, most basic personal finance strategies can be depicted in one scorecard. The need for a scorecard. Well, a scorecard is needed to ascertain the inflow streams of cash, to keep close control of expenditure, to track the extent of savings accomplished, to pursue short term and long term investments. These are the four main areas that we are concerned with in our personal financial management. So, we are now trying to build up a scorecard for this purpose. Areas to consider. I have called it E2SI: earnings, expenditure, savings, and investing. E2SI. Now, earnings. The total earnings I have assumed to be 100%. Anybody's total earnings 100%. So, what are the cash inflow avenues to build up the total earnings 100%? From your job, it's understood. From a side hustle, if you have a side hustle, that's a very strategic way of thinking. The cash inflows from side hustle also is part of the total earnings. And then if you have interest paying investments, such interest received also goes into the total earnings of 100%. So there are therefore three main sources of cash inflow: from job, from side hustle, and interest received. What about the cash expenditure avenues? I have allocated 70% of expenditure from the total cash of 100%, cash inflow of 100%. Now, this 70% can be subdivided into living expenditures, day-to-day living, at 40%, and capital expenditures 30%. These figures I have assumed, but you can assume your own figures. And then, after deducting all the expenditures from the earnings, you are left with savings. So the savings therefore will be 30%, 100% less 70% gives 30%. So how do you use the savings? You use 10% for short term debt servicing and 10% for long term debt servicing. Now these percentages might vary, but I have assumed them as 10% and 10% each. Then you are left with another 10% of the savings, which I am suggesting that you invest. So investing 10%. And these three 10% make up the savings of 30%. Now, when you invest, it need not be 10%, it can be more. But whatever it is, you have four things to consider, four main areas to consider. The inflation rate. What is the inflation rate that you are facing currently? Because if you do not earn interests on your investments over and above the inflation rate, it is of no use. So inflation rate is an important consideration. Then what is the interest rate that you are going to get from the investment? Is it at par with other investment opportunities, or is it better? I suggest that you go into an investment with better interest rates. What is the risk profile that you have of this particular investment? Maybe you don't have one investment, but you have a couple of investments. So when one investment is of high risk, you can select another investment which is low risk. And we will discuss these things further in a later discussion. So the risk profile, therefore, is an important consideration. What about the cost? Cost of the invested amount. How do you know the cost? For you to invest a certain amount, you must assume that there are other ways of investing those amounts where you will earn another percentage of interest. So the interests that you have foregone in order to invest in this particular investment will be the cost of that investment. So this is an area that we need to discuss further in another meeting. Now, consider a $100 investment invested at 10% is allowed to mature for 1 year. So if it is 10%, $100 will become $110 at the close of the first year. And if you do not withdraw the amounts, the 110 will continue to be invested at 10% again. That means the original $100 have become $121 now. So the $121 invested by the close of the third year at 10% will give you $133.5. Simple arithmetic. And then the $133.5 invested by the close of fourth year will give you $146.45. So over the 4 years, $100 becomes $146.45. So that is the power of compound interest. We call it compound interest because what is invested originally keeps on compounding. Okay. So now we can bring up all these areas into one scorecard. We call it the personal finance scorecard or the E2SI model. E2 earnings, expenditure, savings and investment. E2SI. Alright, so cash inflows will give you 100% earnings, and living and capital expenditures will take away 70% of your earnings. Then out of the savings, 20% will go to debt servicing for short term and long term, and there will be 10% available for investing and to compound. So now these rates, as I've told you, I have assumed for the sake of explanation, but these rates will change according to each person. So you can build up the finance scorecard with your own rates and then use it to monitor your performance. Here are some cautions. Build up the scorecard with your own rates and monitor. Most important word here is monitor. You have to monitor. Yet, decide on the rates in an objective manner. That is, you are the best person to know what rates to fix on each of the above items. Once decided, stick with the rates at least for 1 year. Because every time you change these rates, you are giving up control of your performance. So don't do that. Rather, stick with the rates for at least 1 year. Then, convert actual figures of earnings and expenditures and investments into percentages. So that you can compare with the rates set initially. It is better always to compare rates with rates rather than with actual figures. Try always to control the actual figures and not the set rates. So don't mess around with set rates once they have been set. But always try to maneuver the actual values of your earnings, savings and expenditures. So that's all there is to it on this subject, but please comment on further topics that you wish to learn. Thank you very much. See you again.